Good morning, everyone. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion, and we're here to talk about Jobs Day. With me today, we have Catherine Rooney Vera. She's Chief Market Strategist at StoneX Group. Also, Justin Fox, my colleague at Bloomberg Opinion. He's also the author of The Myth of the Rational Market. Today's expectations, as you can see from the table up on our screen, non-farm payrolls is expected to come in at a plus 106,000. That's from a prior 139,000. The consensus expectation on the street is that the unemployment rate will tick up a little bit to about 4.3% from a prior 4.2%. The stakes here feel somewhat significant for markets. Continuing jobless claims for unemployment insurance are already suggesting a modest weakening in the labor market. Meanwhile, private sector U.S. payrolls unexpectedly decreased by 33,000 last month, the worst since March 2023, according to ADP research data released Wednesday. So eco watchers are wondering, is the labor market deteriorating, and will the Fed come to the rescue? Catherine, do you think it is? What's going on here?
Well, yesterday's 139,000 net miss on ADP was significant because it's the largest we've seen since September of 2022. And we've only seen, John, two other times between then and now that ADP has missed by more than 100,000. Now, the interesting part about that, John, is that on both occurrences, non-farm payrolls beat forecasts. So it's hard to imagine, from my perspective, non-farm payrolls beating today, although the bar is much lower because people are revising to the downside their estimates. There's a few sectors that I think that I'm most closely watching, which we've seen a rollover, which I think is important to the economy, which is, of course, leisure and hospitality and healthcare and education. Those were some of the more positive sectors, and we've seen a slowdown there. And so that's what I'll be looking at.
Okay. Justin Fox, what are the big themes and sort of unsolved mysteries in today's labor market that fascinate you at the moment? Where will you be eager to dig in here?
Well, I mean, one of the things that, just talking about the ADP report, is ADP report shows employment sort of collapsing in education and healthcare. And that has not, in healthcare, education hasn't been doing very well, but healthcare has basically been driving the payrolls numbers. And so that's a really interesting disconnect, and it'd be interesting, it may just be ADP's sample of healthcare employers is very different from the overall. I mean, another thing that's going on, the birth death model, and the fact that it does look like, if you look at the numbers coming out of the quarterly census of employment and wages, they're still weak relative to these numbers that we're going to be looking at today. So you probably got to give something of a haircut to all of these. They will eventually be revised downward, not a huge amount, but somewhat. Right. Yeah. And then, I mean, I guess I've been sort of fascinated and worried over the past few years about what's going on with people in their 20s in the US who've had a really weird job market experience over the past few years and are one of the main groups that are still at sort of lower employment and labor force participation rates than before the pandemic. And so just, you can't tell a lot from a month, but that's just something to keep watching.
Yeah. I do want to unpack that later in this conversation. And it's been reflected both in sort of aggregate employment numbers and actual labor force participation. But lately, we've actually seen the unemployment rate for recent college grads really start to tick up. And there's a thesis that maybe it has something to do with artificial intelligence. But all right, so here we are. We're heading into the number. I'll give you a quick market check. The yield on your 10-year Treasury note is about 4.25%. It's certainly stepped down in a meaningful way over the past month. Some of that is expectations that the Fed is going to come in with some rate cuts in the latter part of the year. The stock market, of course, has been on fire despite the litany of geopolitical risks and so forth. And we'll see what this number does for us in just a moment. So here we have it populating. The
It's
change
again.
in non-farm payrolls is a beat, plus 147,000. That was against an expectation of 106,000. Your prior actually gets revised up to 144,000. So that's that's interesting in and of itself. The unemployment rate ticks down to 4.1%.
Wow.
Did not have that on my bingo card,
No.
I gotta say. Now, bear in mind the labor force participation rate is also ticking down a little bit. That's interesting, and we'll want to think a little bit about why that might be happening, especially in light of developments in the immigration policy front. Just to sort of round out our numbers here, though, average hourly earnings, okay, only plus 0.2%. So if you're concerned that this is a too strong labor report for the Fed, I kind of don't know. I mean, you're not necessarily seeing new wage pressures from this. And finally, I want to take you down to initial jobless claims, which are coming out at the same time. This is a separate report, but because we have the holiday shortened week, we're getting these at the same time. Initial jobless claims plus 233,000. So that was a bit softer than expectation and a bit of a step down, but certainly not indicative of a collapse in this most recent week. And then finally, continuing claims we have coming in at 1,964. Okay, in other words, 1.96 million, and that ends up being a step down from the prior, although it's a little bit higher than the survey. But gosh, all in all, this feels like a positive surprise here. What do I make of this extraordinary resilience in this American labor market, Catherine Rooney Vera?
Yeah, it's definitely a positive surprise. I think it for sure takes July off the table. I don't think July was actually on the table in terms of rate cuts, but I think it also potentially keeps the Fed on hold until December of this year with the risk that they don't cut. So I think it's unequivocally positive, and the upward revision to the past month as well. And it also is indicative of the breakdown in the correlation, which was historically weak anyway, between ADP and non-farm. I find it remarkable that we've seen this correlation break down to such an extent that really this is, I guess, not such a surprise that non-farm beats yet again after ADP showed such a weak number. I'm still digging into the joblessness moving lower when participation also moved lower. So unemployment rate is down, but labor force participation is also down. So we'll see what that drop in joblessness was. And I'm also digging under the hood as to the main drivers of this unexpected positive number.
Right, for sure. Yeah, I mean, it's hard to look at this and feel worried that we're in sort of a negative spiral, the sort of thing that you talk about when somebody brings up the SOM rule. But it is interesting to see this, this labor force participation rate ticking down here. There's been some speculation that with what's going on in the immigration policy front, that there could be, for instance, among the undocumented population, you could see some folks stepping out of the labor market because of concerns about workforce raids and things like that. Justin Fox, you think that thesis makes any sense as part of the data that we're seeing here today?
I mean, I can't really see it in this data, but it does make sense that will be an issue going forward. I was just sort of curious about, what sectors were driving this, and healthcare did okay again, but it's government that actually was the big gainer. State and local government, federal government is down a little,
There we go.
but state and local government was the big
how's that
gainer
for
there,
a head scratcher?
which was not something I had been, doing a lot of anticipatory research on.
Yeah, yeah. While I'm pulling up the decomposition, Catherine, I did want to ask you. So we see. I just put up the yield on the 10-year Treasury note. We see it moving up in a big way. You
Oh, yeah.
flagged, yeah, you flagged the fact that this really seems to take speculation about a July rate cut off the table. I don't really know about September here, but what does this mean for the market action, both today and in the weeks to come? The setup for this is, we have a stock market at all time highs. At least some of that had to have been speculation that easier monetary policy was coming. Yields on Treasury notes really across the curve had been coming down over the past month, again in anticipation that some combination of better inflation data and a weaker labor market was going to lead the Fed to cut. So where could we possibly go from here based on what we learned today, Catherine?
I think where we could possibly go is that the Fed cuts more aggressively next year. This is a view that I've heard most emphasized by Michael Gapin over at Morgan Stanley, and I met with him just yesterday, and I think this data kind of proves his point, which is we could get no rate cut at all this year, and potentially 175 next year. Of course, that depends on the evolution of course the data, as this is a highly data dependent Fed, but that's what the market's telling us as well. You see a big move in yield. 2 years up 12 basis points or more, now 390. That's a significant move at the front end. And I think, the steepener has been the consensus trade. It's a crowded trade. I've been on board with the steepener trade. It's done well. I suspect, however, that there's going to be guys and gals looking for duration. I think there are some juicy pockets in the rates market, and I think we could see some movement and some interest in that today.
Okay. Well, I've put our decomposition up on the screen for everybody to follow along here. And so, Justin was talking a little bit about the drivers, but I just wanted to help everybody visualize this. And if either of you want to call out interesting themes, we can dig further under the hood. But basically, what's happened here for this labor market report for the month of June is you see. Let me just pull this up here. Construction, meaningfully positive contribution. Let me just dig in there because I'm always curious with what's going on in housing. It's not coming from residential building construction. It seems to be coming. Well, it's coming from the specialty trade contractors, which includes actually some residential and also non-residential specialties. So that's interesting. Construction's still a positive contributor, despite the fact that high we continue to live in this high rate environment, mortgage rates close to 7%. Manufacturing sheds a few jobs, but with the large margins of errors on this, I'm not going to get too worked up about it. Education and health services keeps on chugging, plus 51,000 from that sort of super sector. It had been 83,000 in the previous month, but still strong contributions here. And just looking under the hood, it's not coming from the education part. It's all about that healthcare and social assistance, something that Justin Fox has written about quite a bit vis-a-vis the state of New York. So maybe we'll get into that. And finally, leisure and hospitality. I'm a little bit surprised by this because I think there's a market narrative out there supported by data that people are traveling less. air traffic a little bit soft. And then finally, Justin Fox called this out early. Eagle Eye Justin Fox. Government, huge contribution.
Yeah.
It's like Elon Musk gets out, and there's a boom in government. No, I'm kidding, because mostly we didn't.
It's not the federal government.
Yes, but it's it's a big move coming from state and local government. That's wild stuff. So, Catherine Rooney Vera, anything specific in this decomposition that jumps out at you, that surprises you, that is consistent with your priors, or forces you to question what we knew about this?
I like your comments, John. I like your comments on Elon getting out and things look pretty. But I think we could also take it another direction, which is we knew that Doge was not going to be as successful as previously estimated. But I think this confirms it. The fact that we've seen that's quite honestly shocking to me that we saw that number move higher, especially after all the headlines saying that we were seeing some mass layoffs and making the size of government smaller.
Yeah, all state and local, though. All state and local in the ads, as Justin points out.
Fine, but let's move on to the construction sector. The construction sector also calls my attention, especially because of what you mentioned, which was the immigration bit of it. But we've seen a surge on the back of what I think is mostly due to data centers, and this is something that at StoneX we've been talking a lot about, John, which is the second derivative of the AI plays. So where can our investors be positioned to benefit on a structural long-term basis the evolution of the AI trade, which still has legs, but for which the main drivers have already seen the bulk of their appreciation. So the second derivative last year, in my view, was utilities did great. This year, in my view, was real estate based on the backbone of warehouses and that type of thing. And that, I think, is what's driving this construction movement. Investment in data centers, large-scale infrastructure build-outs. And we see unemployment in the industry has dropped from 7.2 to 3.5 in last month, and total employment in construction reaching 8.1 million. So I think that's particularly interesting. And then you see a divergence there again with ADP data, which signaled a big slowdown in construction. So this was one of the sectors between, as I mentioned in my previous comments before the number hit, I was most cautious in looking at education and healthcare. And the third one would have been construction as well. So, immigration and deportation activity, I think you would expect to see this play out in the construction sector. But that slowdown that we saw in construction from ADP certainly did not prove to be the case for non-farm. So it's interesting, John, because there's just so much where you think, things are changing, and what is relevant, what should we be looking at in the future? Correlations that historically have worked seem to be breaking down. So it's putting us in a whole new realm of analysis.
Yeah, certainly true. Just to round out our conversation about what's going on here, let me also put up a decomposition of the unemployment rate. And so again, you do see it stepping down to be clear, a rounded 4.1%. You see, like grains of salt in this household survey when we get into 3 decimal point contributions. But you see a step up in the contribution from job leavers, a step down in the contribution from reentrants. Those would be people who were out of the labor market, and now they're looking for a job and not finding one. So there's less of that going on. You could say it's a discouraged worker sort of scenario here, not necessarily bullish there. Contribution from new entrants to the labor market stepping down, similar to what I just said about re-entrants. But permanent job losers. This is sort of where the rubber hits the road. This is sort of the thing that you worry about when you talk about like a labor market doom loop and the SOM rule and all of this stuff. Like there isn't a large contribution to the unemployment rate from people who are losing their jobs. There just isn't a lot of evidence of widespread layoffs in this economy. And people, to be fair, like people have been calling for it for 3 or 4 years now, since the Fed started raising rates in early 2022, and we just haven't seen that sort of thing. Just to round out what I was saying, nothing to comment on in terms of a change from the contribution to unemployment from temporary layoffs, and you do see a step down in the contribution from people who completed temporary jobs. Again, like all of this under the hood stuff, take it with a grain of salt, because we're analyzing very small changes in the household survey. Can be very noisy from month to month, but basically, not much to see here. Justin Fox, I do want to come back to the theme of young people in this labor market and hear what you're thinking about this. You had a phenomenal column on this, I want to say 6 or 7 weeks ago, about sort of what's going on with Gen Z. The funkiness about this generation's interaction with the labor market is not entirely new. Something has been amiss since the pandemic, at least, but it continues to be amiss, and I think it's concerning more and more people, because a recent development is we look at trends in unemployment through the end of the first quarter for recent college graduates, I think basically up to the age of 27, and their unemployment rates seem to be rising to a meaningful degree, meaning they're stepping out of their degree programs, they're stepping into the labor market, and they're not finding work immediately. That also seems to dovetail with what we know to be a very weak hiring rate, which has been weak for a long time. So, like, what are you making of all of this labor market that is not it's not bad in the sense that we have a high unemployment rate, as we saw today, but there does not seem to be a lot of churn, and it seems to really be disadvantaging these young people. What's going on with them?
Well, one of the things, and I sort of got this looking at the breakdown of contributors to the unemployment rate, is just this sense that I wonder if a lot of employers are still sort of burned by the Great Resignation of this situation where tons of people were laid off during the pandemic. Then suddenly the economy came back much faster than most expected. And it became a real struggle to keep people in low wage jobs in particular. And I think a lot of employers have taken away from that. I don't really want to lay people off. I don't necessarily want to hire anybody, but there's just the sort of the job churn that existed before the pandemic has been taken down a notch by that experience, and that'll eventually fade. But and that would clearly disadvantage any labor market newcomers. And you see things like people in their 50s have much, and I haven't checked this month's numbers, but they have like much higher labor force participation rates, much higher, somewhat higher labor force participation rates than before the pandemic. So they're not leaving the labor force as quickly. And maybe it's AI and these sort of entry level number crunching jobs disappearing, but I always am a little doubtful of that, just because in terms of, it definitely might be an issue for recent college graduates, but it seems like less of an issue overall, because most jobs aren't like that.
Right. Yeah, I think the problem with this thesis is we have many sort of macro forecasters who are expecting the macro impacts of AI to really come several years down the line. I see some people who talk about 2027, 2028, but it would feel early to have sort of widespread productivity gains in the general economy from this technology, given what we know from surveys and so forth about levels of adoption and that sort of thing. Catherine, do you have any thoughts on this theme, on what's going on with the young people in this economy?
Well, I think it's additionally interesting and additive to the conversation on young people, this idea of soft data versus hard data, because you mentioned the surveys and AI and the seeming longevity of AI, and maybe it shouldn't take impact right now for the labor force for young people. But the hard data is really, it's really interesting, this divergence between soft and hard, right? Because you have soft data saying consumer confidence was dropping, then it's recovered. Surveys, you look at the Fed Beige Book and regional surveys showing some weakness in recent months. I mean, hard data has not yet proven that. And then on the flip side, when you look at wage growth slowing, that's especially concerning for young earners. And I wonder if AI is kind of proving the soft data wrong and having some impact on those lower wage jobs. I mean, young and entry level workers are the most sensitive to wage deceleration, especially as inflation expectations remain elevated. So, look, I think it's wage growth slowing, cooling isn't positive. Young people seem to be moving the needle on disillusioned workers and exiting the exiting the labor force, and that's not good for early career movement. So yeah, I think that's interesting, and I think that the hard data just continue to prove. I was recently talking on a panel, and one of the panelists called the U.S. a basket case, and I said, well, if it's a basket case, this economy is the most resilient basket case I've ever seen. This is a phenomenally resilient both economy and market. And I think these types of figures undercut, this more negative view that the U.S. is destined for some form of steep stagflation or recession of any sort in the foreseeable future.
Yeah, I generally take basket case if it means 4.1% unemployment.
Exactly.
Durably. But I do want to emphasize, and I truly mean that. I don't think you take 4.1% for granted, and I think a lot of the hand wringing is unreasonable when you come back to that simple fact. But it does remain a very frustrating labor market for some cohorts. It is a fact that there is unusually little dynamism here. It feels sort of stuck in some ways. And at some point, it's got to break out in one direction or the other. Obviously, we would hope that it would break out in a positive way, and that churn that we're used to in this dynamic American economy would come back. And I wonder what the catalyst for such a thing could be. Maybe it's easier credit access and lower interest rates that we get through some change in monetary policy. Maybe it's something that's happening sort of under the surface secularly in the technology space. Could it possibly come from fiscal policy? Justin Fox, what should we be making of the big budget bill that you've been studying so closely here, and how it might interact with the real economy?
Well, I mean, I think one of the things that, and it's absolutely correct of all of us to focus on how much it's increasing the deficit and the debt relative to existing law. But in terms of how much it's increasing the deficit relative to like the existing deficit, it's not much change at all. Right. I mean, that's the whole point of the bill. It's just to sort of mostly extend current policies with then shifts in various places. And so, I mean, it means no real improvement unless somehow we just tariff revenue totally surprises all of us. But it also isn't really worsening in any big way. And so in that sense, it's kind of there's lots of other parts of the bill that are big news. And I really do wonder, like we were talking before about the effects of more deportations, more immigration enforcement. I mean, there's a crazy amount of money that's going to be going into ICE and DHS now. And I don't know. I mean, I imagine they will waste a lot of it, but it's just still this big open question that Trump really did during the campaign, say he was going to deport everybody. Basically, everybody was here without permission, including a lot of people were here with permission, and he's revoked the permission. And if that were to really happen, I mean, it would have the societal impacts would probably be bigger than the economic ones, but that would start having a really big impact. Yeah, it'd probably be helpful for some of those young workers, but it'd kind of be terrible for the economy overall.
It would be
Okay.
terrible for the economy, John, and I would say that the probability of that is so low that's why I don't think it's being priced into the
Right.
markets, because it's such a low probability event. It's not happening right now. So, but something, John, I would like to get back to one of your questions, which I think was a really interesting one, which is what would precipitate this change in the labor market dynamics, and I just go back to bare bones, like basic logic to me would say, look at corporate earnings, right? Because if corporate earnings remain resilient and corporations are doing great, they're not going to let people go. Justin talked earlier about this, and I think he's right. The hangover of the inability during COVID to fill those seats and to place really good people sticks in corporations' minds, but much more if they're highly profitable and earnings growth has been remarkably resilient despite economic uncertainties, and that's been really impressive in my view. So I think we would have to see some rollover therein for there to be a noticeable worsening in the labor market.
All right. Well, our half hour today has flown by, absolutely. So I want to thank Justin Fox and Catherine Rooney Vera for joining. A quick market check before we let everybody go. That yield on your 10-year Treasury note is still hovering around 4.33%. So on the back of this this report, we see that that sort of key benchmark stepping up about 7 basis points. Your unemployment rate in the United States of America, incredibly, 4.1%. So, feels good. Let's not take it for granted. Thank you all for joining. We'll be here for CPI on the 15th. Take care.
Thanks, John.
Thanks, John.